Hello everyone, welcome to the channel of Trigonometry. Today is February 9th, Monday. So we had a big bounce on last Friday after a three back-to-back red candles, and then we have a continuation of an upward movement in the QQQ and S&P 500. These bounces are fully expected. After a big sell-off, there will always be bounce. Especially after a very dramatic sell-off, we tend to get a big bounce back. Now, right here, QQQ is sitting right at the resistance. You can see as the moving average converge at this level from 616 to 615. So here is usually where stocks get sold off again. So as I predicted, um, by the end of January, on January 28th, I basically predicted the top was in, which is the FOMC. And then we have a massive sell-off on the QQQs. And then we're bouncing towards the moving average. And I don't think this sell-off is finished just yet. I'm going to tell you why I think the sell-off is not done yet. And now let's take a look at my account. So I have two major accounts I'm more actively trading on, which is my traditional RIA and my Roth IRA. So year to date, I'm returning over 7% in my traditional IRA, which is my bigger account. Uh, if you look at the all-time chart, it's up over 400%. So basically, I started over 300K, over 300K. Now it's up 1.7 million. So a return of over 400%, almost 5x, over 5x in the past 2 years. And this is my Roth IRA. So if you look at it, the all-time, it's pretty staggering at 3,400% return over 2 years, where I started at over only $23,000. Now it's at 800, over 800,000. And year to date, I'm returning over 34% year to date, up over 200K. So these are my two actively traded accounts. Why I trade IRA? Because I don't need to pay tax on them. So I'm fully using that to my advantage. Um, I've made a lot of trade this year, and mainly I made most money on my puts. I'm shorting the market. As you can see, I've made a lot of money buying QQQ puts and IGV puts. I've also wrote an article why I'm bearish on the software, and IGV is the software ETF, which has a lot of the SaaS name that get absolutely demolished in the past couple months. And let's go back to the chart. So I wrote this article regarding the software industry as a whole facing massive margin compression and also the headwind from AI agent like Anthropic and Google Gemini and ChatGPT. So I think the fundamental change in the software industry is still going on. Even though we see a little bit of bounce in the last 2 days, I don't think the sell-off is completed just yet. As a matter of fact, I think a lot of the software company in this sector is still very expensive and overvalued. They're still not fully pricing in all the risk that AI is bringing to this entire industry. So if you're interested in my article, uh, I'll put this link in the description so you can feel free to check it out. So I described why um, these software companies will face a lot of pressures, and also I name all the companies specifically, including Salesforce, ServiceNow, Adobe, Figma, DocuSign, Snowflake, Team, Datadog, UiPath. So I've named a lot of stocks in this article. So if you have read this, you probably wouldn't be buying the dip on these companies because I don't think the dips is in just yet. I think there's additional bearishness coming from the Mac 7 because of the capex. Microsoft, Google, Amazon, Meta, all these hyperscalers, they're spending huge amount of capex. By estimation, I think all these hyperscalers combined will be spending over 600 billion in capex with AI infrastructures, and most notably, Amazon, Google, and Meta are issuing debt to help facilitate these capex spend because they're running out of cash. Yes, that's right. The richest company in the world are running out of cash. They need to raise additional debt to support their capex spend. Why is that a problem? Because in the past few years, all these companies have extremely strong cash flow. They're money printers. They print money like crazy and they spend those money on stock buybacks. And that's a huge part of their stock appreciating over the past few years. Now, with this huge capex spend, they can no longer sustain those stock buybacks. That's why those price premium from these hyperscalers will go away because they can no longer spend the money on stock buybacks. And you can see it on the chart as well. You take a look at Microsoft, it's down from the October high to the recent low. It's pulled back almost 30%. You don't see Microsoft pull back 30% very casually. This is something fundamentally has changed for this company. Although Google, if you look at right now, it's still trading at near all-time high. However, it could very potentially see the similar path like Microsoft in the next few months. And the logic is pretty simple, very, very similar. It's the capex spend, and they can no longer buy back stocks. And surprisingly, a lot of a lot of these hyperscalers cash flow, free cash flow will turn negative in 2026 by the current metrics they're providing. So these are the fundamental changes to Mac 7 stocks. And also, I just mentioned all the software stocks are facing immense pressures. They can no longer enjoy the price premium, the high multiple, the high margin they are used to. They are facing re-rating. The entire software industry and the Mac 7 are facing re-rating. Those will put a lot of pressure on the QQQ, NASDAQ 100, which has most of the tech stocks in there. I think on this week, on the macro side, we have additional catalyst on from the job market and the CPI number as well. I believe on Wednesday, we are going to have the non-farm payroll. This is a very critical number because we're already seeing a lot of layoff in January, and um, we will get a closer look at this non-farm payroll number, see if we still have healthy employment. This is also one of the uh, big data point that the Fed looks at when it comes to making the decision of the monetary policy. And on Friday, we have CPI report, probably the single most important data point that everyone's looking at. So currently, the forecast is 0.2%, and the consensus is at 0.3%. I believe the forecast is coming from the economist, and the consensus is from the Wall Street. So we're seeing some difference, but overall, I think both of them are underestimated. Because if you simply look at the oil price in January, the oil price in January, it went from under $68 to all the way up to $78. The high was over $80 in January. The oil price went up a lot, so it will absolutely impact the headline inflation numbers, both month over month and year over year. So I think all these numbers are being understated. Um, it will also impact the core inflation number as well, most likely, because when oil price goes up, everything else goes up. So I think these are mainly the two most understated risk by the market as of right now. We are getting close to the market close, and I think QQQ is still holding at 0.8% today, but you can see towards the close, it's go coming down a little bit. Tomorrow, I don't think we have much catalyst, but I think everything tomorrow will be setting up for Wednesday and Friday, where we get the non-farm payroll number and the CPI number. I do think market is due for a larger pullback, but by no means I'm predicting a bear market. I think we will retest one of the larger moving average for QQQ, probably 580, and um, for SPY I'm seeing probably 650. Um, I think as of right now, market is still overly optimistic about both the employment and the inflation. So until we price in those risk factors, I remain bearish. Even though I do have long positions, I still have most of my long positions in my investment portfolio, but I have a lot of hedging positions at the same time. Until we complete the pullback, I'll remain hedged. If you have any questions or comments, please leave in the comment section below. If you are interested in joining my Discord channel, please check the link in the description section. I'll be sharing all the thesis and ideas and my trades and live market analysis and a lot of very, very good information there. So, and that's all for today. Thank you. I will see you next time. Bye.